Good afternoon. This is Sean Golding with Golding and Golding. As we approach the October deadline for taxpayers on extension, we get a lot of inquiries regarding offshore voluntary disclosure, how to do it, why is it important, what you need to know. So, continuing our under 10-minute segment, we are going to explain offshore voluntary disclosure, the different options, etc., in under 10 minutes, hopefully. So, when people, as an aside, when people say offshore voluntary disclosure, that's a more general term of all the different types of amnesty programs. It's not referring specifically to the Offshore Voluntary Disclosure Program, that OVDP they call it, that was terminated back in 2018. So the U.S. tax system is a little different than most other tax systems. It follows something called citizenship-based taxation, which is a misnomer in and of itself because it doesn't just involve citizens. So taxpayers who are U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test are required to report their worldwide income, and they are also required to report their foreign accounts, assets, investments when they meet various threshold requirements. Focus of the offshore voluntary disclosure presentation today is just the reporting, not the tax implication. So all different types of foreign accounts, assets, investments have to be reported. Commonly people think of bank accounts, which of course is reportable. You've got savings, checking, current, things like that. But all other types of accounts are typically reportable as well. Investment accounts, securities accounts, equity accounts, mutual fund accounts, unit trusts, ETFs, foreign, of course. Like a U.S. retirement account that has foreign assets in it, those foreign assets aren't reportable. They're talking about foreign pension plans, superannuation, SIPs, MPFs, EPFs, CPF in Singapore, things like that. Depending on which particular form you have to file, and the threshold will impact the due date, whether you have to apply for an extension or whether it's automatic, such as the FBAR, whether you get an extension in conjunction with filing for your tax return like the 8938, or whether you have to file a separate form, 3520A, which requires a 7004, which is a separate form used for things like 1120s and things like that. So you mix this all in a pot and you go, oh geez, I didn't know I had to do all of this, right? I get income, I report my income. I have tax returns and I file them, and I haven't missed a return, and yeah, I have income overseas, but I file returns in those countries, or it's TDS, and I pay taxes overseas, and it's deducted at source, and what's going on, and what do I do? So if you are a U.S. person, you are out of compliance, and you want to get into compliance, there's various different programs that you could submit to, and let's get a little bit into the different programs. So, in determining which program a taxpayer qualifies for in order to perform an offshore voluntary disclosure, the key question is whether they're willful or they're non-willful. We have a ton of different resources on our website about willfulness and non-willfulness. It's the most important component. Because if you're willful, the only option available is the voluntary disclosure program. If you're non-willful, there's lots of other different programs you can submit to. Streamlined procedures, domestic, offshore, which is for taxpayers who are U.S. residents, streamlined procedures, foreign, offshore for taxpayers who qualify as foreign residents, and delinquency procedures, and even reasonable cost. But so let's start with willfulness. If you're willful, you do the voluntary disclosure program, you do the pre-clearance letter. You don't do that for the other programs. With a pre-clearance letter, you wait. You get your confirmation typically. You have to go 6 years of amended returns or original returns, 6 years of FBARs, and as part of the new program, you have to go through an audit or an examination, an interview with the agent that's assigned. Typically, these are fine. If you have unreported domestic income as well, it can get a little stickier, but still, for the most part, if the primary issue is your offshore income and assets, then it's pretty straightforward. You pay a 50% penalty on the maximum value of your unreported accounts and a 75% penalty, which is a fraud penalty based on the highest year's unreported tax liability on the income. That's VDP. Now, you'll still see OVDP online. VDP has been around forever. OVDP was a specific offshoot for offshore-related submissions. They terminated that specific program back in 2018, I believe it was September, and now it's just merged back into VDP. So you just go through the typical VDP procedures, even though they've gotten rid of OVDP technically. For taxpayers who are non-willful, there's a lot more flavors of ice cream available that you can eat. For example, if you're non-willful, let's start with streamlined. It's called the Streamlined Filing Compliance Procedures. That's broken down further: streamlined domestic, streamlined foreign. If you qualify for streamlined foreign, it's 3 years of amended or original returns and 6 years of FBAR. There is no penalty, which is great. You can use the foreign earned income exclusion typically in foreign tax credits, but there's very specific requirements depending on whether you're a citizen or resident during those 3 years, permanent resident, or whether you met the substantial presence test, and so the tests are different. Streamlined Foreign is the best program, again, because you submit the certification, so you're all good with the IRS, and there's no penalty. Then there's Streamlined Domestic. Streamlined Domestic is 3 years of amended returns and 6 years of FBARs. Why do I stress amended? You can't generally file original returns with Streamlined Domestic. Instead, you file amended returns. So if you didn't do original returns, you can't do the Streamlined Domestic offshore procedures. 3 years of amended returns, 6 years of FBARs. For both of these programs, you have to be non-willful. And with Streamlined Domestic, it's a 5% penalty on the highest year's December 31st annual aggregate total unreported balance. So what you do is you look at December 31st for the 6-year compliance period. You pick the 1 year that has the highest unreported aggregate total on December 31st, and you pay a 5% penalty. Now, certain assets are not included. Your rental property, unless it's in like a society anonyme or an other entity, is typically not included. Canadian RRSPs, RIFs, and possibly other types of retirement plans in Canada. But aside from that, for the most part, you're going to pay a 5% penalty. There's also something called the delinquency procedures. The delinquent FBAR submission procedures means all you have is the FBAR. You didn't file it. There's no unreported income. There's no 3520 for foreign gift. There's no 8938 because you don't meet the threshold, etc., etc. And they still waive the penalty. They can change it, but they still waive it. Now, the reason I stress now is because there's another program, Delinquent International Information Return Submission Procedures. That program also waived all of the penalties, but they stopped doing that as of November 2020. It's the same as delinquent FBAR, except there's some additional reporting you have to do. No unreported income. Maybe you received a foreign gift you didn't report on 3520, or foreign trust, foreign corporation, etc., etc. Some taxpayers, they don't want to go directly through a disclosure program, so if they can show that they had a reasonable cause and not willful neglect, whether before they receive the penalty or after, then they can either avoid the penalty or have it waived. 3 key things to know. Why would you get into compliance? Because the IRS is increasing enforcement. They've been really pursuing fines and penalties against taxpayers. The penalties can be significant. In a recent case in Bittner, they limit non-willful FBAR penalties, for example, to $10,000 a year. But let's say it's a married couple. They each have FBARs. That $10,000 adjusts for inflation. You're looking at $120,000 to $175,000. And then you also have possibly Form 8938 penalties, depending on what the threshold is. So they have been going after taxpayers more. By doing an offshore disclosure, it gives you the opportunity to set the narrative. It gives you the opportunity to go in there and tell the IRS what's what in terms of the facts and the circumstances. Now, for this last minute, I just want to explain this. There is a lot of fear-mongering out there, a lot of nonsense. Attorneys who are not board certified, who claim they're board certified, they make up designations that they're experts even though they're not. When you're talking to an attorney, 99% of the time, it's going to be civil and not criminal. And most of the time, it's going to be non-willful. It's not going to be willful. So usually non-willful, sometimes willful. Criminal is rare. Criminal is typically going to be a situation where there's other crimes, money laundering, tax evasion, tax fraud, structure and smurfing, etc., etc. For taxpayers who are out of compliance, our website has a ton of free information that you can go through. We have our main website and a couple of different sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Have a nice rest of the day, and it looks like we made the 10 minutes.